So it's hard to see what other countries can give by way of concessions to the US. So if you just leave China aside for one moment, your average import tariff on the US is 1.5%. In Germany, for example, it's 1.3. In Japan, it's 1.6. So what can these countries give to the US to avoid the reciprocal tariffs? Europe's not going to scrap its VAT, for example. Now, let's look at China. The pain for China is a lot less, frankly, than it is to the US. So China's exports to the US are about 3% of Chinese GDP. Now, if they disappeared, some stimulus would make up for that. And we've been talking about maybe 2 trillion renminbi of stimulus would probably offset the negative impact. So what can China give? If the US looks at the example of the 1980s, when Japan was the problem, that's when Trump first started talking about tariffs. The Japanese allowed the yen to double in a year. They went in for voluntary export restraints, and Toyota started building factories in Kentucky. There's no way the Chinese are going to do that. So I think Xi Jinping says, you're going to be in a lot more pain than us. We're going to bear this out. We can eat bitterness, etc. So very hard to see where any concession comes from, frankly.
Goodness. Okay, so they're going to fight to the end is the official line from Beijing. But let's talk about other kinds of response, what China could do. Sherry started with you on the currency, right? And you're looking for, from where we are now, H is offshore, we're at 28.37 or so, about 10% down from there. You wouldn't be surprised if we had an 8 handle on dollar China, which obviously a lot of neighboring countries, especially in Southeast Asia, aren't going to be too happy with, right? What about the other issue? And I think we headlined this as well a couple of minutes ago. Japan coming out and saying, look, we're going to be talking to the U.S. fine. We're not going to weaponize or use our holdings of U.S. treasuries, though, as leverage. What about China, though? Because if I'm not mistaken, at least at last count, China, I mean, they change places almost every year, right? China right now holds more U.S. treasuries than Japan. In fact, they hold more U.S. treasuries, foreign holders, than anybody else in the world. We've talked about how if they were to slow or stop or even sell their treasury holdings, they would shoot themselves in the foot. In this case, what is the risk that if pushed into a corner, they may actually do that?
Well, at the most extreme case, it's possible. But, if I'm right that they want to weaken the currency, just think about it logically. If they were to sell their U.S. Treasury holdings, and remember, Ali, it's about probably $2 trillion worth that they own. And you're right, they and China and Japan have about the same. If they start to sell that, they're going to be selling dollar, bringing the money back to renminbi. That's going to push the renminbi up. So if their main policy is going to be to try and allow the renminbi to depreciate, they don't want to be doing that. I think Japan is actually the bigger problem. And I don't think China was selling, for exactly the reason I explained, over the last couple of weeks, U.S. treasuries. But if you're a Japanese investor, and I remember being in Japan in February, talking to an asset allocator at a large Japanese fund, and talking to him about Stephen Moran, the chairman of the Council of Economic Advisors, his plan to have century bonds or to have a tax on foreigners' owners of treasuries. This allocator had not heard about this, and he literally went pale in front of me. You could see him calculating the hundreds of billions of U.S. treasuries he owned. And it's all very well for the Japanese government to say, we're not going to sell U.S. treasuries, but it's not the Japanese government that owns them. It's Nippon Life. It's the GPIF, the Government Pension Investment Fund, which is an independent body. The government can tell them don't sell, but if they decide for economic reasons they are worried about their exposure to the U.S., they're worried about all this policy randomness and lack of breakdown in the rule of order in the US. We want to reduce our exposure. Not a lot the government can do about that, frankly.
They could do it on their own, I understand, Garry. But, I mean, if they were to do that, and these are pretty big institutions with big holdings of U.S. treasuries, would that be enough to trigger a second unwind of the yen carry trade?
It would, because if you're a Japanese investor at the moment, and JGB 10 years yield or 1.2, the US is 4.7. But if you actually are a yen-based investor, and you hedge your foreign currency exposure or FX exposure, you get about a 200 basis point pickup in running yield if you buy JGBs. So that's already been happening, and that's the unwinding of the yen carry trade. I think there's some evidence that the decline in Magnificent Seven stocks was driven by that. So that, of course, the Japanese have the largest international investment position in the world. You know, they have a lot of money in various different markets. If that money starts to get repatriated to Japan, you know, that will clearly be a negative. It's one of the reasons why we think that the yen is actually probably the best safe haven at the moment if we have a global recession, if we have continuing turmoil in markets. The yen is going to, I think, appreciate significantly because its fair value, purchasing power parity for yen dollar is 91. So it's dramatically undervalued where it is trading at the moment at 143, 144.